GDP. Or, wait, what? Gross domestic, GDP. GDP, not GDP? We might have to go back and edit some of those videos. Anywho, GDP, or gross domestic product, is the total amount of all the consumer spending, government spending, imports and exports, and business investment spending. All stuff we're going to be getting into in this video. Current economics. Anyway, gross domestic product. There are two types of purchases that are made in the economy. There are intermediate purchases, which are the purchases of intermediate goods and services, ones that are used to produce or different product or service. And there are the final products, and there are the final purchases, the ones that are made by the consumers buying the end good products. Now, GDP only takes into account the final prices of the product. It does not take into account any sort of intermediate products, nor does it take in anything that happens under the table, because the GDP is reported by the government, and if it's under the table money that the government doesn't know is being spent, then it can't be reported by the government, which means that the $15 you got from babysitting isn't really going to affect the GDP. There are three different ways to calculate GDP. There's the expenditure approach, the value added approach, and the income approach. We're going to go over all these approaches a little bit, but expenditure is going to be, the expenditure approach is the one we're going to be talking about most on this show, because it's the one that's commonly used by the AP macroeconomics exam. And so we'll start with the value added approach, which effectively only calculates the value added by each time the product is made. All of the GDP models work to avoid double charging for a single good produced, meaning that you don't want to count the price of the steel in addition to the price of the final sell price of the car, because technically that would overinflate GDP, because it's the same steel is being counted twice. However, with the value added approach, you only calculate the amount that the value of the product grows from when the company buys it, from when the company buys it to when the company sells it. Meaning that you're going off of the sales price minus the purchasing price. So if I bought the steel for $100 and sold the car for $200, I only added the $100 to GDP. Now, are those numbers realistic? No. Can I do complex mental math in my head? No. That is why we used such a simple number. Now I'm going to have to get out of the car and go to swim practice here soon, but let's just go over income, the income-based model, which uses the sum of the payments of factors. You'll remember factors from the last video, and if you haven't seen the last video, I would highly recommend going back and watching it. It's a hoot and a holler. I think you're going to have a good time. But, someone took my parking spot. Shame. So, calculates the amount of money spent to factors when calculating GDP. Now, the final one is the expenditure approach, which, as I mentioned before, is the one that we are going to be using the most on this show. Now, okay, I understand I'm not driving in the car, but you get the picture. I'm in the car. I'm talking about economics, e-carnomics. Expenditure, the final value so that's the final value. So in our car example, it would be only the price of the car, the price of the steel, and the price of the steel would not be counted in GDP at all, which is, it makes sense, right? Because the steel is an intermediate good in this case, while the car is the final good being sold to the consumer, right? So, we are using the expenditure model in our example simply because it makes the most sense and because it's what preferred by the College Board. And welcome to America, where the College Board sets the agenda. This is very informal, and honestly, to Mr. Gears, my teacher who's making me do these videos, very sorry, but we'll bump the rating up on this one. So the expenditure approach is simple. You take consumer pricing, the amount of spent on consumer goods, the amount spent on business investing, the amount spent by the government, and the amount spent with imports and exports to calculate total GDP. Now let's take a brief moment and run you through all these. Consumer goods is anything purchased by the consumer, goods or services. If I bought the car, I spent my $21,000 or whatever it is. That's still very cheap for a car, I think. Anyway, I spent a certain amount of money on my car. That's consumer spending, goes straight into GDP. Also goes straight into GDP anything that I spend on services. So if I'm hiring a plumber to come fix my pipes, that money that I spent goes into consumer spending. He reports it to the plumber reports it to the government counts it in GDP. However, if that plumber was fixing his own pipes, he would not count that in GDP because he's not paying himself to fix his own pipes. I suppose if you think about it in terms of opportunity cost, sure, maybe, but no, GDP doesn't work. We also have business investment spending. Now, this isn't fake investment spending, which is spending money in the stock market. Remember that anything, oh, no, we didn't talk about that. Important note to remember. Consumer goods only count on new goods in that year. So if I buy a used car from 2015 in now, which is 2018 for people in the future watching this video, it does not count for GDP because I am reselling that car, because that car is being resold. Same thing happens with stocks. You're not actually buying anything new. You are simply buying something that was already there. So it does not count in terms of GDP. However, investment spending does work for any physical thing that the business is spending that's not a one-time purchase that's going to help increase profits in the future, such as a training program for their workers or building a new factory. Also included in business investment spending is houses. Why is this? Because the government doesn't want to have to differentiate between houses being used for rent and houses being used to live in, so they just lump all houses into investment spending. Remember, investment spending and the houses in investment spending are only if the house was built in that year. If I bought a house from 2016, that house increased the GDP of 2016, not the GDP of 2018, where we currently are, because it was not produced in this year. Remember that. I promise at least one of you watching this video will mess that up. The next part of the expenditure approach is government spending. Government spending is, I suppose, anything the government really spends money on. Anything from building new schools to creating new parks, any sort of income. No, not income tax. That's money the government takes. That doesn't get included in GDP. However, any money that the government distributes, which includes any sort of grants that they give for certain things, or things like an unemployment index. Oh, Madison and Kat left this on my car during swim practice. Interesting. We will put that there. We'll come back to that. That's great. Okay, so after government spending, we have imports and exports. Now, it's important to remember that in terms of GDP, imports are added opposite of their value. They're added as a negative value, or money spent out of our economy, while exports are added as money in. A very common mistake is to flip these and subtract exports and add imports. Think about it this way. We have to spend money from our economy on our imports because we're buying it. So the imports count negative towards our GDP. In the last video, we talked a lot about GDP, which, fun fact, is not GDP. I thought it was GDP. But anyways, the problem with just knowing how to calculate GDP is that by itself, it doesn't really tell us anything. Sure, it's great that we have that the US has the largest GDP in the world, but does that mean anything to me? No, of course not. GDP is extremely useful when comparing the sizes of different economies. For example, Japan, the third largest economy in the world, has a considerably lower GDP than the United States, showing that the US's economy holds more weight in the world than the Japanese economy. However, while looking at current GDPs to compare different economies in the now, it can be useful, it becomes slightly less useful when trying to compare one economy with itself over time. The problem is that comparing what is called the nominal GDP, or the now GDP, the current GDP, with the nominal GDP from past years, is that GDP does not, the two nominal GDPs occur at times when prices were different. The change in prices between the past time and the current time artificially inflates or deflates the GDP, providing us not quite accurate numbers as to how much the actual pure production of goods and services is growing or decreasing in the economy. To deal with this, we use real GDP. Now, the difference between real and nominal is something that you're going to want to remember, because especially in this unit, it's going to come up quite a bit. However, the real GDP is GDP adjusted for inflation. That means that in order to calculate your real GDP, you have to pick a base year across the span of years that you are comparing. Now, quite often, this compared year will be year number 1, but it doesn't have to be. The premise is simple. You take the prices from the base year and multiply it by the goods and services provided in each consecutive year following. That gives you your real GDP. By setting the baseline prices and then comparing the GDPs after that, you account for any inflation and provide... Anyways, real GDP, after you adjust it for the inflation, allows you to compare year by year solely based on the changing variable of number of goods produced. Changing it based on number of goods produced allows you to see how the production of the economy and the overall economy is growing. Now, I'd like to go back to a point that I'm sure you were all thinking earlier on in this video, when I talked about how the United States GDP was much higher than Japan's. Well, that's obvious, isn't it? The US simply has more people to work. Shouldn't they be producing more goods, and shouldn't they be providing more services? Yes, which is why economists like to also use a third measure of GDP. That's right, another one. So you have your real GDP, your nominal GDP, and you also have your GDP per capita. GDP per capita is effectively GDP divided by the total population of the country. Effectively, the average GDP per person in the country. GDP, now there's a bit of an urban legend that goes around about how economists really only care about the GDP per capita, which isn't necessarily true. And if you think about it, I think you'll agree too. GDP per capita only talks about the production per person, but it doesn't account into any of those other things that kind of make life worthwhile, right? It doesn't consider leisure time, it doesn't consider housework, it doesn't consider hobbies, and the problem is that there's actually a lot of things that most people don't like that increase the real GDP, such as divorce. But I think you've pretty much got the hang of the 3 types of GDP. So for now, this is Duncan Fox, driving away from AP Economics.